When you're deciding on what types of stocks to choose, one thing you can look at is growth stocks or growth investing versus, let's say, value or income type investing. So growth stocks or growth stocks are ones that are going to be priced higher to the market or in their industry. The whole idea is these are high-flying stocks that you think will have a great future. Maybe they're a high technology company that's working on some kind of new technology, maybe around some new demographics or things around virtual reality or augmented reality, whatever it might be. Or it's a pharmaceutical company, maybe a small pharmaceutical company that's working on the next blockbuster drug or wonder drug, whichever it might be. And it can be in any industry. You're looking for stocks that are going to grow relative to their peers much, much faster. And we mean by growth, not only are they going to grow their sales and their revenue, and hopefully they're going to grow their profits and their earnings, which means it's going to grow the stock price. So with growth stocks, you're really looking for stocks that are going to grow your stock price. You're going to buy here, you're going to buy low, and you're hoping they're going to grow fast and outperform the market, so later you can sell high and make a profit there. You know, these are stocks that don't necessarily pay like dividends or income or anything because they're trying to invest in that growth. So growth stocks are priced to be high to the market. You're looking for that momentum and that future to drive their price up. And they may not even be profitable yet. So they might be running, negative or hanging on there, so to speak, because they're investing in their company and they're looking to, then maybe come to market with something new. So they might not be profitable yet. Growth stocks are great for the long-term investor because you're really betting on that future. You're looking for that great future. So you need to be a long-term investor, and you need to be patient too. These are not overnight sensations typically. Sure, things happen, and when something gets announced, maybe the stock will rise dramatically, but it takes years maybe to get to that point, and you want to be in before that big announcement or maybe before that blockbuster drug is released or whatever it might be. So growth stocks could be something that might take some patience over a longer period of time. Also, growth stocks tend to be a lot more volatile or go up and down price a lot. They're more of a roller coaster because people are betting whether it's going to be great, or if they don't see it's going to be great, then they're going to pull out right away and maybe try to bet on the next great thing. Or there might be a bad announcement. Maybe they're delayed in their process for whatever they're working on that a lot of people are excited about the future for them, and maybe there's a bad announcement or a delay. So they can go up and down in price pretty dramatically at times. The idea is you also want to protect your downside. And we mean by that, if stocks are really kind of going down, 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 even a growth stock, you might want to get out because it might not ever come back. I've seen reports where they talk about if you're down 20%, maybe that's the time to get out. Well, heck, maybe it's time to get out when you're down 2, 3, 4%. But there comes a period where you got to look at it and say, boy, this is way down, and I'm never going to recoup my money back, and maybe this just isn't going to work out as a growth stock. And you do all your fundamentals, you do your continual analysis. Maybe you're looking around at other companies, and you just have to bite the bullet, so to speak, and take those losses. So understand with growth stocks, they can have a great potential, but they can also have a bigger downside. So be aware about that and protect your downside. What you're looking at from a fundamental standpoint, or maybe like financial ratios and things, is that they have fast rising sales and earnings. The whole idea is that they're growing quickly. They're outperforming the market. So when you're comparing within an industry and compare to the market, but really compare within their industry, technology, health, energy, whatever it might be, see that they should be growing their sales and their earnings faster than their peers. And we get in the ratio area, we'll talk about that more. But growth stocks grow faster sales and earnings. Also look for growth stocks that have low debt. That doesn't mean they necessarily have no debt. Debt's okay because they're taking on debt to help fuel that growth. But if they take on too much debt and they're not growing their earnings, or maybe they haven't had earnings yet, or they're not growing their sales quick enough, they might have a hard time servicing that debt or basically paying off that debt. And that could hurt them and hurt their results and really maybe constrain their growth because they're too busy trying to pay off that debt. It didn't turn out the way they wanted to. But some debt's okay, just so it's not a high level of debt compared to the industry and their peers. And the lower the debt, the better in this case for growth stocks, looking to ride that sales and hopefully earnings ramp up and not always up and down, and certainly not down. So from a ratio standpoint, look for that. A couple tips around growth stock investing and some things to look for. One is think about the industry as a whole. If you're a growth stock, but you're in a bad industry or a poor performing industry, you might be great, but the industry is going to hold you back. You won't have that. Investors will look at that industry and maybe stay away from it just because they don't like the industry at all at that point of time. You could be a growth stock, let's say in the buggy making industry for making buggies for horses. And you could be like, wow, I'm the best at making buggies, and we got a brand new buggy coming out. It's going to be terrific. But you know what? Nobody's really excited about the buggy making industry versus, let's say, maybe an alternative fuel car, whether it's electric, but even getting things like hydrogen cars or solar cars or self-driving cars. Those are the high-tech industries for those that people are excited about and want to invest in that. So if you're a growth company in that industry and things look great for you, you're going to get a lot more investors, and that'll drive your stock up. So look for growing industries as a whole. So that's one thing you can look at as you're evaluating growth stocks. So think about the growing industry. Think about also trends that are out there. Some of that qualitative data. What's going on in the market? What's going on in the world? What are you seeing? What are you just kind of observing in the world around you? Or maybe you're seeing some facts and figures coming from think tanks or government sources or education research or whatever, showing here's some big trends that are happening in the world, some big mega trends that are happening in the world. So for example, you have a lot of folks in the baby boomer generation, right? The older generation that are retiring now. So that's a growth area for people who might manage money for people who are retiring, and how to get more income and manage money for that might be a growing area. Or it might be a growth area for pharmaceuticals or medical technology firms. A trend is there's a lot of older folks, a lot of boomers out there, and they're living longer, which is another big mega trend, which is terrific for all of us that we're all living longer. But it's terrific if you're making things to help ease that life or help maybe people to live longer. Those could be great growth stocks in the areas of like healthcare or biotechnology, whatever it might be. So those are some trends that we're seeing now. And as well as on the other spectrum, where there's a large amount of millennials out there now. What does that mean for how do they act, and how are they different than maybe the boomer generation? And you can go beyond just trends of people and demographics. Look at other trends, from technology to what might be happening in the world around trends, from eating trends to everything that's out there. Globalization certainly is a big trend that's going to be impacting us for many, many years to come. How can you play in a globalized market, for example, and how can a company be globalized or ramp up quickly too as well, as far as looking at these overall trends. Another is to think about if that growth stock has a strong brand, which would be kind of a barrier to entry. If they're the first mover, let's say in the industry, or at least in a segment of the industry, and they've got it kind of nailed, and they're doing great, and they're growing fast, that first mover advantage can be very, very strong. It's a barrier to entry for others to come in. And there will be competitors, and others will come in, it's just they might be more reluctant to go take on somebody who's really dominating an area and really growing. I mean, think about how much energy does it take, how much resources does it take to compete against like Google in search, or Facebook with social media. I mean, these are big moving companies who are growing, they're growth companies, and it's hard to compete against them. Doesn't mean you can't find your niche and maybe take little pieces away from them. Just saying if you're going to compete head to head, that would be a barrier to entry versus something that it's easy to maybe get involved with, maybe a local restaurant or something of that nature. Another thing for growth stocks, and that maybe have been growing for some time, is look at what the insiders are doing. What are the management team, the CEOs and the executive team, what are they buying? And we have a section on insider trading which talks about how to look at, and how to see where people are buying and selling at the top level. But you can go waste online, Yahoo Finance, or go into the annual report, or go onto their site, and you'll see publications or things that shows whether they're buying or selling stock. So if they're buying lots of stock, that's another good trend for a growth stock. If they're all piling out and cashing in, but maybe they're piling out because things are going to maybe look bad in the next couple upcoming months, that's something just to be aware of. Doesn't mean if they're cashing in, maybe they're just trying to take that money out for themselves personally. But if everybody's piling out, that's a warning sign. So just be aware of what the insiders are doing. And then lastly, from just an overall fundamentals type thing, some guidelines. These are not hard or fast, but some guidelines when you're evaluating growth stocks that can maybe help you as far as evaluating them against their peers in the industry. One is we talked about sales increasing and earnings increasing. Well, they should be at least increasing by 10% or more per year. Is a good guideline to use. So if they're growing even faster than that, great. But if they're really only growing like 1, 2, 3%, heck, if they're growing like 1%, they're not even keeping up with inflation. Well, they're not really a growth stock and shouldn't be evaluated as such. Maybe they're a good income stock, but they're not a growth stock. So look for sales and earnings rising above 10%. And then look for debt that's decreasing debt, at least lower than the previous year. Look at like their debt ratio and look at the amount of debt that they're carrying. And if they're continuing to add debt on top of debt, well, they might be having a hard time paying their debt, but also financing their operations. So they're kind of like taking out extra debt to try to make it all work. And in the end, if you pile on too much debt, well, then it's like a house of cards that'll all fall down. So be aware of anybody who's increasing their debt year over year. If they're decreasing their debt and they've got sales and earnings that are rapidly growing, hey, that's a great sign as far as some things in growth stocks. And lastly, look at ROE, or return on equity, about 10% plus as well. It's another way to show how is your investment, your equity, what are you putting into the firm, the equity that's going in the firm, how is your return coming on that, and looking at that 10% or more when you look at the ROE figure. And we'll look at that in all the whole ratio section, but here's some good fundamental things to look at when you're looking at growth stocks. And and some growth stocks might, like I said, might not even have earnings yet, so they might not be making 10% or more a year. It doesn't mean their stock won't go up. Amazon, those kind of companies, it doesn't mean their stock doesn't go up. Just it's something to look at when you're looking at growth stocks, and some good rules of thumb and guidelines around ratios. So if we use some examples of growth stocks to wrap up this section, household names that you would know would be categorized in this, like Amazon and Facebook and Apple, of course, and Biogen and Uber, right? Uber is new and growing. It's a kind of this new thing. And Starbucks, of course, is continuing to grow and adding. At some point they'll grow so far they might become more of an income stock, or they might plateau. We'll see. But they're considered a growth stock. But Uber is a good example where it's a tech stock. Really, it's a tech stock that does ride services, cab services. Really, a new way to kind of look at that. It's it's new. It's in its infant stages still, and it's really kind of growing. And it's got a lot of markets it can still get into and grow. Doesn't mean it doesn't have issues like regulatory issues and all those things. And some countries adopt, some don't. Unions in some countries are opposing it for the taxi unions versus Uber and how Uber works. So those are things to take into consideration when you look at. But they would be like a growth stock like these other ones as well. So growth stocks, to wrap up, great for long-term investors. That's the idea. You want to get that capital appreciation, buy low and sell high, and maybe your next stock will be if somebody bought Apple at $5 and now look how big it is, with many stock splits along the way. So that's what you're hopefully going to be for you when you look at growth stocks.